Now I'd like to introduce Mr. Jim Caffin. Please go ahead, sir.
Thank you, Brian. Hello, this is Jim Caffin, President and co-founder of Sortino Investment Advisors. Thank you for joining us today. By way of introduction, I'd like to offer a brief look back at Dr. Sortino's journey along the path to America's investment crossroads, the focus of this webinar. In 1981, Dr. Sortino and Dr. Forsey discovered a consistent disconnect between the returns investors needed to meet future cash outflows and their actual results. From there, Dr. Sortino and Dr. Forsey worked with top international scholars to solve this performance dilemma and to devise a more manageable way to participate in capital markets. This new understanding of how to measure and manage investment risk and volatility ultimately gave rise to SIA's pioneering DTR Navigator. Our purpose today is to introduce Dr. Sortino's breakthrough postmodern portfolio theory for constructing portfolios and our DTR Navigator service for managing those portfolios. Our DTR Navigator service will help take your advisory practice to the next level by increasing investor confidence through the use of a logical, science-based approach to investment management and will allow you to improve cost efficiencies and increase revenues while maintaining a high level of investor service. So at this point, I'll let Dr. Sortino explain postmodern portfolio theory and the science that makes it work. Dr. Sortino?
Thank you, Jim. I'd like to begin by saying hello to my friend Yurdal in Turkey and Hattori in Tokyo. Thank you, gentlemen, for joining us. I'll use this slide to point out a few problems with modern portfolio theory. In other words, if there's no problem with that, then why change? Robert Merton was one of three people who got the Nobel Prize for developing what we now call modern portfolio theory. He wrote an article in the Harvard Business Review in July of last year, in which he said, the goal that we identified back in the 50s gives people the wrong notion that they should maximize the wealth relative to some level of risk they're willing to tolerate. And the metrics that we used of maximize expected returns for a given level of risk were the wrong metrics. In other words, if you have the wrong measure of risk, you're going to get the wrong utility function, which will be tangent at the wrong place on the wrong efficient frontier, and you get the wrong portfolio. Other than that, it's a great idea for introducing the notion of a risk-return trade-off to young students. So, what is the correct goal? Merton says the correct goal is to focus on those future payouts that people are investing for. In other words, to replace some percentage of their salary at retirement. And we would agree with him. But what I want you to take away from this slide is the focal point for us is that green arrow, that line that connects the present value of the assets to those future payouts. We call that the desired target return. That's the return that you need to earn on your assets in order to achieve that payout. So how should we measure risk and return? Well, the way that modern portfolio theory measures risk is that distribution there at the bottom where it says modern portfolio theory, that is tighter than the distribution up above for postmodern portfolio theory, indicating that it is less risky. However, if what you have to earn at minimum in order to achieve that payout is that red line, the desired target return line, then returns that fall below that desired target return line incur risk. And the farther they go below, the greater the risk. As you can see, that distribution for modern portfolio theory lies entirely below the DTR line. So how can it be less risky than the portfolio above. It guarantees failure. The entire distribution lies below the DTR line. Are there any assets like that out there in the real world? Well, how about a money market fund that invests solely in treasuries? So the risk for people who are trying to achieve some payout at retirement is that the returns fall below the DTR line. The part that lies above the DTR line is the potential to exceed that DTR. I developed the upside potential ratio with some friends in Groningen University that takes the potential to exceed the DTR divided by the risk of falling below the DTR. And I believe that that is the best risk-reward trade-off. I would like you to think about investing not as a wealth maximization problem, but as a navigation problem. You're trying to get from where you are financially to where you want to be in the future. And that line, that DTR, is the line that connects your assets to your payout. Well, how do you generate that DTR? The next slide. We solve for some rate of return. Let's say it's 8% on the present assets, that you need to earn an 8% return in order to achieve that payout. And let's say that we believe that a 60-40 mix would achieve that. What would you do when you're blown off course? If you were a navigator, you would plot a new course to your destination. And that's what we do with portfolio navigation. Plot a new course to where we're trying to go to. How does portfolio navigation compare with other corrective procedures? The most popular one is rebalancing. Well, if a 60-40 mix would have gotten you to your destination initially, and you're blown off course, so you're now down below, rebalancing to 60-40 will just put you on a parallel course. You'll never reach your destination. If the winds that blew you down to that remain, then you'll be below that, somewhere in that cone of rebalancing. What about liability-driven investing? Well, liability-driven investing would increase your fixed income component. Now, I remember when I went to Tokyo to speak at a conference there, that was in 2009, at the bottom of the market. And the most popular strategy then was to recommend liability-driven investing. What I was recommending and what the output from our optimizer was recommending was increasing equity, not increasing fixed income. So how do we go about constructing portfolios with postmodern portfolio theory? Our optimizer solves for the combination of active and passive managers that will exactly fill up the asset allocation and provide some added value. That's represented in those diagrams there on the left. The blue distribution is an all-passive portfolio, and the black is a combination of active and passive portfolio managers that would fill up those boxes and give you some added value. Well, what if all we had were the mean and standard deviation? In that case, we would know which one was better. Yes, the active has 11.3% versus 9.5%, but it also has a higher risk, 8.4% standard deviation versus 6.9%. What does the upside potential ratio tell us? It says by hiring some active managers, the ones that are selected with the optimizer, you could get 30% more upside potential than downside risk. Whereas if you invested solely in the passive, you would get 10% more downside risk than upside potential. What's the payoff for having active managers? That's the DTR alpha at the bottom. It says that those active managers could add as much as 180 basis points in any given year. Let's compare our methodology with target date funds. Here we have two participants, participant A and participant B. They both have the same goal, replacing 70% of their salary at retirement, both the same age, both want to retire at 65, they both have the same salary, and they're both deferring the same amount of money, $7,000 a year. The only difference is that participant A already has $45,000 in his portfolio. Target date funds would put them both in the same portfolio, saying they both want to retire at the same time, they both get the same portfolio. What would we do? We would calculate the DTR for each participant and put them into one of 5 portfolios based on their age difference, their retirement, their salary, their deferrals, their assets. Each one of those variables would create a different DTR that would identify which of the 5 portfolios they should go into. So it is not a one-size-fits-all strategy. Now I'd like to turn it over to Lisa to show you how this would have worked if you started at the top of the market in 2007.
Thank you, Dr. Sortino. This case study illustrates Sortino DTR Navigator during the 2007-2008 financial crisis. Our investor in this case study is Martha, who's saving for retirement. Martha's 55 years old, contributes $10,000 a year to her retirement account, and has $700,000 in retirement savings. Martha joined Sortino DTR Navigator at the top of the market in May of 2007. She's on track to meet her goal of achieving 70% of her pre-retirement income at retirement, and her calculated DTR is 6%. So she's placed in the DTR Level 2 portfolio. As the market declines, Martha's account is reviewed on a quarterly basis, and she's kept apprised of the effect it's having on her assets. In March of 2008, her account balance has declined with the market, and that has changed her DTR to 8%. Martha's account is moved to the DTR Level 3 portfolio, which contains a higher percentage of equity exposure. By September of 2008, the market has declined significantly again, and Martha's DTR is now 10%. Her account is moved to the DTR Level 4 portfolio, which contains an even higher percentage of equity exposure. And by December of 2008, her DTR is 12%. Her account is moved to the DTR Level 5 portfolio, which contains the highest equity exposure in the DTR Navigator program. The market hits its bottom in March of 2009 and begins its steady recovery. By December of 2009, Martha's account balance has grown and her DTR has reduced to 10%. So her account is moved back to DTR Level 4 in its reduced exposure in equities. By March 2011, her account balance has grown sufficiently, and her DTR is now 8%. Her account is placed in the DTR Level 3 portfolio with an even further reduction in equity exposure. Note that this is not a market timing approach. Portfolio navigation doesn't try to predict upturns and downturns in the market. The changes to Martha's portfolio are based on her needs, not the market. However, the effect of managing her portfolio by need causes Martha to purchase equities when they are less expensive and sell them when they are relatively more expensive. In this example, Martha's account outperformed the same investment in just the S&P 500. It was also far superior to the emotional behavior of most investors who abandoned the market at the bottom. Sortino DTR Navigator is a service you can employ in your practice with defined contribution plans, defined benefit plans, endowments, or individual investors. It can be utilized as an SIA-branded service or as a white label service under your own name. Sortino DTR Navigator is only available to investors through professional investment advisors. SIA does not work directly with individual investors. SIA designs the 5 asset allocations and manages the DTR portfolios on several platforms as model portfolios. They are also available for 401k and other qualified retirement accounts as the Sortino DTR Collective Investment Trusts through Alta Trust. To execute portfolio navigation, SIA and advisors work closely together, including calculating the DTR of each investor and generating a list of specific recommendations for that investor. However, all communications and execution of navigation changes and recommendations are done by the advisors. I'll turn it back over to Jim Caffin. Jim, you might have us on mute.
Sorry, thank you, Lisa. We believe partnering with SIA will be transformative for your practice because your clients will perceive that your investment design tools are better since they're based on factual personal data, not a confusing risk tolerance questionnaire. They'll know what to expect from their asset allocation strategy and knowing precisely what return and contribution rate is required to meet their individual future cash outflow needs. They'll know what the investments selected for their asset allocation are the ones most likely to meet or exceed the required annual return. And lastly, the use of the most scientifically advanced financial guidance system to navigate their specific financial destination will inspire them to refer you business. I know we've covered a lot of ground today, but hopefully this webinar has given you a sense of how much real progress has been made on the way to a new investment path. One where investment planning no longer focuses on merely beating the market, but instead measures success in terms of the real progress each investor makes toward achieving their financial goal. It is hope we have convinced you to consider choosing a new DTR-driven path, a path and an ongoing partnership with the SIA team that will prosper your clients and your practice for years to come. To learn more about SIA, Postmodern Portfolio Theory, and DTR Navigator, you can visit our website or reach out directly to us by contacting me, Jim Caffin. Again, thank you for listening, and if anyone has any questions, we can answer those now.
You can send us questions using the chat feature of the WebEx meeting. I have one question here, which I'll go ahead and answer. It's asking what platforms we work with. For our model portfolios, we're on Schwab, Fidelity, and Raymond James. The collectives are available on a wide variety of platforms. I've got another question. How often is an investor's account reviewed and possibly modified? I'll go ahead and answer that one as well. An investor's status is reviewed quarterly, and their DTR is calculated quarterly. If there's any change in the DTR, they would be moved at that time to a matching DTR portfolio. Changes are not extremely common. You're not going to end up moving people into different portfolios every quarter unless we see something drastic in the market or there's a drastic change in their account, say a large withdrawal, for example. The MapBest report, which is the report that sends information and recommendations, is sent annually. And I've got another question. What is the cost of the collectives? The cost of our collectives are approximately 1%. That's all in, including underlying investments. I've got a question here for Dr. Sortino. How many statistics does your model calculate, approximately?
Let me see. Certainly there's the upside potential ratio and the DTR alpha. But in order to get to those statistics, 20 or 30. We also do the style analysis. that Bill Sharp developed. So all of these statistics to generate a 3-parameter log normal distribution and the bootstrap procedure and all of the other things, it's quite a developed program. I give all the credit for that to my colleague, Dr. Hal Forsey. He's the mathematician.
Okay. I've got another question. This would be for you, Dr. Sortino. Can you give us a sense for the investment composition of the portfolios?
We do not deal with hedge funds or use leverage. So it would be domestic equities, foreign equities, and fixed income. We do have real estate and for alternatives and energy stocks, but there is no leverage.
Okay. And if another question, do you ever create custom portfolios? I'll go ahead and answer that. Yes, that we can create custom portfolios when our investment minimums are met for those portfolios. Another similar question to that. I'll send this one to Dr. Sortino. Do you do ongoing research on investment management allocations if we have one particular investment that we would want included?
I'd be willing to talk to you about it.
Okay. And another question, how do we find more detailed information about your process? I think JK kind of covered that on the website. There's a lot of information on there, white papers, a video library. There's also 2 books that Dr. Sortino has written on the subject with an excruciating amount of detail, and we've got links to those books on Amazon. Okay, I've got another question here. Where do you get your asset allocation? And I'll go ahead and answer that. We use our own asset allocation strategy developed by Dr. Sortino for the defined contribution plans and other investors using the model portfolios. We will use an established asset allocation within a defined benefit plan or an endowment that has significant investable assets. See, I've got another question here. Do you have any broker-dealer relationships? Let me send that one on to JK.
Yes, we have broker-dealer relationships, but each one has its own unique requirements, and we'd be more than happy to discuss with senior management how we might develop a relationship.
So with that, I'm going to close